The views and opinions expressed on this program are not necessarily those of this station, JVC Broadcasting Management, or its sponsors.
The opinions voiced on this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. As always, all performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. Hello and welcome to Financially Speaking. I'm your host, Tony Zambri, Managing Director, Financial Advisor with Zambri Financial, powered by LPL in Melville, New York. You can catch this show live every Wednesday evening at 5 o'clock right here on 103.9 LI News Radio. And if you happen to be out of the listening range, you can always go to the station's website, www.linewsradio.com. Click on the Listen Live link, or you can download the station's app and listen to us that way for anywhere you've got connection through your phone. And of course, I'd be remiss if I didn't remind you, if you want to contact me for any reason, please go to our website, zambrifinancial.lpl.com, ZAMBRI financial.lpl.com. All right, folks, welcome to 2025. I mean, I know we had that last Wednesday show, but the markets were closed. This is our first trading Wednesday of 2025. And it's brisk out there on the island. It's 25 degrees and windy outside the studio right now at L.I. MacArthur Airport. So it's winter. It's winter. It's 2025. It's a new year. So we're going to look at what happened today in the markets, what's happened in this first week of trading in the markets. We're going to recap last year. We're going to go over some changes that are important for you to remember as we head into this year, and we'll see where that takes us. So today, much like yesterday, markets were up, down, sideways, finished mostly up. Dow and the S&P were higher, NASDAQ a little lower. Dow was up 106 points, closed at 42,635, up 0.25%. S&P was up 9 points, closed at 5918, up 0.16% today. NASDAQ was down 10 points, closing at 19,478, minus 0.06, so 0.06% today, and the aggregate bond index was up 0.1% today. For the year, so last week, normally I say Wednesday to Wednesday, markets were closed last Wednesday. Tuesday was the last trading day of 2025. So the week-to-week numbers and the year-to-date numbers are the same. This is going to be the only time that's going to happen this year. So since last week and year to date in 2025, the Dow is up 0.21%. The S&P is up 0.61%. NASDAQ is up 0.86%. And the aggregate bond index is down nearly 0.5%, 0.43. So stock indices generally a little higher, bonds lower so far in the first week of trading in 2025. Now, let's take a few minutes at least and see what happened last year in the markets. Really, I overall, very good year. And I'm going to say a very interesting year. And we'll dig a little bit into these numbers and see if we can make sense of anything. So the Dow was up 15%. Last year, 15.0, S&P up 25.0. So there's a 10% dispersion between the Dow and the S&P. And I find that to be fascinating because, it wasn't too long ago where most people kind of use the Dow and the S&P almost interchangeably. They would say, well, the market. And when you ask them what do they mean by the market, they say, oh, the Dow or the S&P. And the numbers were generally pretty close. This 10% dispersion that we've seen between the Dow and the S&P is now becoming more common. This year, the dispersion favored the S&P, and it was just a couple of years ago in 2022 that the dispersion favored the Dow. Who it favors isn't really that important. What's important to note is that there is a large dispersion now between the Dow and the S&P. And a large reason for that is because the S&P is what they call a cap-weighted index. So the size of the company matters. So we've talked, in the past about the Magnificent Seven, but these companies have tremendously large values, and as such carry an outsized weighting on the S&P. So to a large extent, the S&P's performance is going to be driven by the largest group of companies within the index. And that's not necessarily what people are always holding. So it's going to be kind of fascinating to see how this plays out going forward. NASDAQ, by the way, last year up 29.6%. In the aggregate bond index, the Bloomberg Aggregate Bond Index was up 1.3%. But if we peel the layers back and we dig a little bit deeper into these numbers, let's see where some of this performance came from and where it didn't. So the Russell 1000 Growth Index was up 33.4%. The Value Index up 14%. So again, a large dispersion favoring growth versus value. The Russell 2000 Small Cap Index up 11.5%. So small caps trailed large caps tremendously for calendar year 2024. They made up some ground at one point through, I want to say, October, November. But as interest rates kind of ticked back up in mid-December and continuing into this year, those small caps have given back some of the gains that they had in using to catch up to either the S&P or the Dow. Foreign stocks, the MSCI EAFE, Europe, Asia, Far East Index, was up 4.3% only last year. So trailing U.S. stocks by a tremendous amount, 4.3%. Emerging market stocks, MSCI Emerging Markets Index, up 8.1%, better than the large companies and the large countries, but still trailing U.S. indices across the board. So, people have been saying for years that foreign stocks are poised to outperform. I know that there's a lot of large banks and investment companies that are saying the same thing as we head into 2025. What I will say is this, by comparison to large cap U.S. stocks, large cap foreign stocks are undervalued. PE ratios of U.S. large cap stocks significantly higher than the PE ratios of large cap foreign stocks. However, I would say that there is some justification for that, in that U.S. GDP growth has been much more solid than what we've seen in, for instance, developed Europe. So there may be a reason to justify higher PEs, higher valuations here in the U.S. Than overseas. Again, looking at the raw numbers, there's no way to argue that foreign stocks are valued lower than U.S. stocks, and perhaps offer a better buy-in. But again, I think we've got to look at that in the big picture and understand that there might be reasons for that. As we turn to bonds, again, I said the Bloomberg Aggregate Bond Index was up 1.3% last year. However, if we look simply at 10-year treasuries in 2024, minus 1.7%. By the way, same exact number for global bonds, the Bloomberg Global Aggregate Bond Index, minus 1.7% in 2024. Municipal bonds, the Bloomberg Municipal Bond Index, up 1.1% in 2024. So, at and around zero, a little above, a little below for bonds in 2024. If we look at turning back to U.S. stocks, the top three performing sectors: communication services up 40.2%, information technology up 36.6%, consumer discretionary up 30.6%. Those are your top three sectors from 2024. Bottom three sectors: materials, dead flat, up 0. Healthcare up only 2.6, real estate up 5.2. Really kind of cool when we could say that the worst performing sector was even, didn't lose money. Most years when we're looking at worst performing sectors, we're looking at negative, sometimes substantial. But this year we're looking at the worst performing sector coming in at 0. A little bit surprising maybe that healthcare was only up 2.6. And I might say a little bit surprising that real estate was up 5.2. Because I do think that real estate, especially commercial real estate, certain sectors of it, there's going to be some trouble spots ahead, at least in my humble opinion. All right, music is playing. That means we're coming to the end of the first segment. Once again, you are listening to Financially Speaking. I'm your host, Tony Zambri, Managing Director, Financial Advisor with Zambri Financial, powered by LPL. Please go to our website, zambrifinancial.lpl.com, ZAMBRI financial.lpl.com. Be back in 2.